You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate expert Max Sharkansky. Now, Max is a co-founder of Trion Properties and oversees all aspects of acquisition, disposition, and property analysis for the firm. Since founding Trion Properties, Max has led the acquisition, renovation, and disposition of over $300 million in mismanaged and distressed assets. Now, prior to co-founding Trion Properties, Max was a senior associate at Marcus and Millichap from 2002 through 2006. While at Marcus and Millichap, Max managed the sale of several $1 million in real estate throughout the continental United States, specifically in the multifamily arena, elevating him to one of the top-ranking brokers in Los Angeles. And here's what you're going to learn in our call with Max today. You're going to learn how Max got started in real estate shortly after college as a multifamily broker with Marcus and Millichap. You're going to learn how Max transitioned from the distressed debt side to owning the physical assets. You're going to learn what specific fundamentals changed leading into the 2007 financial crisis that signaled that there might be uncertain times ahead. You can learn how Max and his team define heavy value add and why they prefer this type of opportunity versus a more stabilized asset. You're going to learn about the formula that his team uses to ensure that they never over-improve an asset to where the return doesn't justify the cost of improvements made. You can learn how Max navigates operating in states that have a high risk of rent control restriction. You're also going to learn why Max prefers a vertically integrated property management and construction firm versus outsourcing to a third-party outfit, and much, much more. And so with that, guys, I'm excited to share with you the exciting and very informative conversation that I had with Max. But before we do, just have a few quick housekeeping items to run through. Now, first and foremost, as of this recording, we are weeks into the national economic shutdown due to the COVID-19 pandemic. And now more than ever, the world is in an absolute state of shock. And that shock has found its way into your household in one form or another. And so with that, I want to take a moment and I want to share some of the positive things that have come as a result for me personally during this seemingly very negative and volatile time. And so to start, I thought I'd share a very powerful quote from our 36th President of the United States, Lyndon B. Johnson, that is very relative to the times that we're living in at present. And here it is. Yesterday is not ours to recover. Tomorrow is ours to win or lose. Again, yesterday is not ours to recover. Tomorrow is ours to win or lose. And so my question to you is, how are you going to position yourself given these trying times to win tomorrow? Okay, so all this craziness that we're dealing with on a day-to-day basis, how are you going to position yourself, your family, your business to win tomorrow? Maybe set a reminder for yourself to answer this very question before going to bed tonight. Not just tonight, though. How about tomorrow night and the following night and the night thereafter, right? Use it to help place yourself in a position to conquer your day, no matter what craziness that day throws your way, whether it's the COVID-19 pandemic or some other type of craziness that occurs in our daily lives, right? Maintain control of your life and set your own terms, guys. The world is counting on you. This isn't just your family counting on you. This is the world. We're in this fight together. We're all counting on each other to push through and make better times. So getting back to what I wanted to share with you guys, the positives that have come as a result of the pandemic that we're currently dealing with, okay? Positives that have affected my family, things I've noticed and that I've taken away as a result of these crazy times that we're dealing with today. So my family and I, we've taken more bike rides together over the last 3 weeks than probably what we collectively did in all of 2019. And for those that know me, then you'll know that I love riding bikes and we ride bikes often. However, the last 3 weeks, we have gone on multiple bike rides a day, okay? Sometimes as many as 4 bike rides a day. And what better way to bond with family than to share this passion that I have with my family? So we all have bikes. We all, go out and ride multiple miles at a time. Even my 3-year-old, man, he's been cranking out like 3, 4, and 5 miles at a clip on each one of these rides that we do, which is quite impressive. He's not doing training wheels or anything. We got him off training wheels like literally 4 months ago, and the guy's cruising. So in addition to the bike rides that we've done together, we've also instituted the daily BUP dance party. Okay, and that happens every day at 11:30. We let the boys pick the song that they want to play, and then we simply just let loose in the kitchen. It's absolutely been a blast, and it's been a great way to kind of break up the monotony of them doing their homeschooling, or at least my 6-year-old doing homeschooling, the 3-year-old just causing ruckus in the household. My wife, she's an absolute saint because she's been dealing with them a lot during the day, and she's been trying to get her own work done. I've been in our home office, which is kind of detached from our main house, doing my thing, and so she's just been an absolute saint dealing with the boys. And the BUP dance party, we all come together. I come down from my office and we get together at 11:30 and we just go crazy. So that's just been a great fun ritual that we've come up with, and probably will continue doing even after this pandemic's over with. I'm pretty sure of it. And also, following the success of the daily dance party, we have recently started the end of the day pool party, where no matter what the weather is, me and the boys go crazy in the pool together. And I'd say that even though we're down in Florida, the water temp is still a little too chilly for my wife, and so she simply just watches. She has not joined the pool party yet, but that's been a lot of fun as well. Again, every evening, no matter how chilly it might be, or the water's pretty cold. Even for me, the water's a little cold, but we still get in and we go crazy together. The boys, again, 3 and 6 years old, they don't really care about the water. Could be frozen. It could be a frozen pool, and they'd still jump into it, and so they absolutely love that. We are very blessed to own a boat, my family and I. We've spent many years in the water. We absolutely love that part of our life. And so we've spent many evenings these last couple of weeks just practicing social distancing while enjoying sunset as a family out in our boat together. And to us, these are just prized moments that we'll hold on to forever. And lastly here, I've got many other things, but I'll just share one more. My wife and I, our relationship has only gotten stronger over these last 3 weeks. Our relationship was always super strong, but with the added complexities of both kids being home during the week, her and I have come together as a much more cohesive unit, and it's been an absolute pleasure spending time with her as well. Much more time than what I would have, being at the office every day, Monday through Friday. And actually, guys, one more thing here I want to make a mention of that's been a big positive for us is I've gotten to know my employees on a much more intimate level, which is kind of strange because we're not in an office together now. However, I feel like we've actually connected on a much greater level through Zoom and through our daily phone calls during this crazy time. And times of stress such as the ones that we're dealing with today has only brought us closer together. And I absolutely love our team at Sunrise, and I'm incredibly grateful to have each and every one of them with me here, especially given the times that we're in. So I'll finish by asking you this. What positive moments have come as a result of this seemingly negative time? Okay, what are those positive moments for you? I want you to take some time to actually sit down and write down the things that you're grateful for that have come out of these last few weeks of you being quarantined and stuck in your house and going a little crazy. I'm sure a lot of you are going stir crazy, especially folks that are in colder climates that maybe might be in New York City, you're in complete lockdown, or one of the other places in the country that's in complete lockdown. And so I want you to find the joy in every day and know that we'll all get through this together. And I love you all, and I wish you health and I wish you strength as we push through these uncertain times. And so, guys, that's all I have here, for this week. We're going to get on to the show with Max. And, last week, if you listened to the show, I promised you as well that, during the coming weeks, I'd start divulging more and more information about the parking lot investment space and why we're so gung-ho about that new asset class and, what we're going to be doing here over the coming months to deploy capital into that niche. But today's not going to be that. I'll be sure to get back next week and to give you much more intimate details of the parking lot space. And so with that, let's get on to the part of the show that you guys have been waiting for, which is our interview with Max Sharkansky. So here we go. Hey guys, it is my honor to introduce my guest for today's show, founder and managing partner of Trion Properties, Max Sharkansky. Max, how you doing today, my friend?
I'm doing well. How are you?
I'm doing great. Very much looking forward to having you here. Looking forward to getting a better understanding of you and your business, Trion Properties. You've been at it now for many years. And so what I'd love to do here to start off things, Max, is for those folks that aren't familiar with you and your story, ultimately the founding of Trion Properties, maybe take a few minutes and just give us a little bit of background of how you got into this space and ultimately what it is you do at Trion Properties.
Sure. So I got into the real estate business straight out of college. I went to LMU here in LA. And I knew I wanted to get into real estate. I did some interviewing and I started my career out as a broker. I was brokering multifamily properties in the San Fernando Valley here in LA. I did it for about 5 years at Marcus and Millichap. In my last year there, my partner and I started buying. My partner was on the finance side at a firm by the name of HFF, which just got acquired by JLL. Lots of acronyms in our business. And we just started very organically, used some of our savings, and we were raising money from some of our colleagues at Marcus, HFF, friends, family. You call everyone you know when you're starting the real estate business. And we bought our first couple properties in the San Fernando Valley end of 05. We continued buying into 06. And then we left and opened up our own shop at the end of 06. We bought through the last cycle, and we were fortunate enough to have a good time. And we sold the portfolio that we had aggregated in 2008 prior to the crash. And as we were selling, we changed our acquisition strategy from value-add multifamily to buying non-performing debt secured by multifamily, as well as some REO. We saw what was happening. We saw the writing on the wall. And we figured that a lot of these owners aren't really owners. They're more like zombie owners because they don't have any equity. So we started calling on the banks. And it took us about a year for our first closing. In 2009, 10, 11, 12, we had a very successful downturn. We bought nothing but non-performing debt and REO. So during that period, we did not do one transaction with an individual, just from the institutions. And then coming out of the downturn, early 2013, we picked off our last REO in Sacramento, California, and then went back to the value add business. And ever since then, I've just been doing it on a larger scale and growing geographically as well.
Got it. So very, very, lucky on the market timing, 2008. So it sounds like you sold out your portfolio. You guys walked away clean, and unlike tens of thousands of others in the country here today. But so kudos to you on that. As far as diving into the distressed debt space, talk to me about what the actual business strategy looked like. So took on the debt. Obviously, you've got these zombie owners, as you put them. They don't have any equity. What was the strategy? Was it to reconfigure that debt with these existing owners? Was it to push forward and foreclose on that debt? What have you? Just give me a general idea what that looked like.
So that's a great question, and that really depended on where you were in the cycle. So early on, when everything was just really, really bad, it was a foreclosure because there was no possibility of a workout. These properties were 50, 60% vacant. It was just impossible to work out, and it had to reset. So we would take it back, almost always amicably. We would call the borrower after we bought the note and say, hey, we're the new lender. We're willing to work something out with you. And we would take it back. Of the 15 or so non-performing notes that we bought, so during that period, we did about 20 deals, about 15 non-performing notes, and about 5 REOs. So of the 15 notes, only one of them went BK. So it was always very amicable and very clean. So in 2000, I would say like 9, 10, 11, it was mostly foreclosures, either a straight foreclosure or a deed in lieu of foreclosure, where they would just give us the keys. And then once the market started to improve, we were able to do workouts.
Got it.
Which is great.
Yeah. And what was the average size of debt we talking about? What size were these assets? Are we talking about smaller multifamily, larger multifamily, just generally speaking?
Smaller. It was $2 to $10 million stuff.
Okay. Fantastic. And just to give everyone a sense of geographic focus, you guys, based on your portfolio that's on your website, this is all California, Oregon based?
Today, yes. It's all California, Oregon based. The last year or so, we've been trying to buy in Denver, Colorado. We love the fundamentals there, but as of right now, we're LA, Bay Area, Portland, Oregon.
Got it. Just got back from Denver last night. It's amazing what's happened out there over the last 10 years, as far as the pricing is concerned.
Amazing.
So let's talk about some of these different transitionary times of your business. So 2008, you're able to exit out, you keep your business intact, and move forward to the next stage of life there, which was purchasing the debt and also the distressed REOs, what have you, and then basically moving on then into, I think 2013 is what you mentioned, when you bought your first heavy value add multifamily project. And from that point forward, that's what you've been focused on. So talk to me about those different transitionary stages and, just really what that looked like from a planning aspect on your side. I mean, maybe you had a crystal ball in 2008 and you knew, like, everyone kind of saw the writing on the wall, but just no one knew when that knife was actually going to drop. And so talk to me about, the mental process you and your partner went through selling off and then actually getting that new focus into that new stage of your business where you guys are going to put that emphasis, which is on the debt side. What'd that look like for you?
So in 2007-8, when we saw this stuff started, we saw the writing on the wall because the fundamentals were changing. We went through about 6-7 years of just straight up growth, very low vacancy, increasing rents, and very strong fundamentals. And all of a sudden, in end of 06, going into 07, it started to feel a little bit shaky. We would get more vacancy. Asking rents started to trend down. That was during the first wave of bank failures. It was during the first wave of REOs, notice of defaults. Things just started to seem like they were about to go. And we had the conversation and said, it might be time to start exiting and start calling, if values are going to drop, let's start with construction loans, because naturally that's what goes first.
Sure.
So we put everything on the market. January of 08, we put most of our portfolio on the market in that first quarter. And then we had a couple properties that we were still finishing up. And then as we were selling, we started calling lenders. It was very difficult to do a deal because the bid-ask spread was huge. And what I mean by that is the lenders still didn't realize what was happening. So we would offer them, they thought that a loan that was in default, they would be able to recover 90 cents. And that wasn't the case at all. We were offering them more like 60 cents. So we couldn't get a deal done for about a year and a half. We started calling in January of 08. We closed our first portfolio of notes in the summer of 09. So it took us about a year and a half. And then from there, it snowballed because by summer of 09, the economy had collapsed. And and we were able, and the banks actually started to get stuff off their books because they realized what was happening. So, so for example, if a loan was $10 million on an asset that was worth 14, 13, at that point, the assets were worth 8. We were trying to buy it for 5 or 6.
Got it.
So, in 08, they still hadn't, they found that to be unfathomable and quite frankly insulting when we made those offers. We said, hey guys, it's not, what we're offering you isn't a function of what the loan is. It's a function of the property's value.
Yeah.
So don't take it personally, but it is what it is. And then it finally worked out. And then as the market started to clear in 2012, 13, we realized that there were no notes left to buy. We bought a little bit in retail. So we just, we're doing so well with it. We said, hey, let's try something in a different asset class. So we picked off some non-performing debt on shopping centers, which was really cheap. And then in 2013, we just went back to our old business of buying value-add multifamily. Got it. Okay. I've been growing it ever since.
Yeah. So let's talk about that. Let's talk about today, where we're at today. There was a, just one of the random properties I pulled off of your website underneath your portfolio listing, and it was I think recent, meaning 2017. I think is what you told me when you guys actually acquired that asset, and it's under the name Park 88, and right. And in the description there, it's described to be a heavy value add project. So maybe give our listeners a definition of what heavy value add means to Trion Properties.
So heavy value add is our bread and butter. That is what we target. That is what we love. That is where we thrive. And that's where we're able to generate the highest returns. And what we mean by that is, and you'll also hear us use the expression blank canvas value add play. So we're typically buying from somebody who's owned it for 10, 15, 20 plus years. That particular property, Park 88, we bought from a family that bought it from the original developer in 1966.
Wow.
Extremely low cost basis, no debt. They had absolutely no reason to drive rents. They were just cash flowing. We purchased it from them after the parents had passed away. We purchased it from the heirs, and the property was just in like antique type shape. It looked like a time capsule. So we went in, we spent about $25,000 a unit. We gutted the units. We did vinyl plank flooring, brand new kitchen cabinetry, stone countertops, stainless steel appliance package, brand new vanities in the bathrooms, paint, of course. And we did in-unit washer dryer. That's a huge selling point up there. Then for the amenities, we redid all the pools. We added gyms. So because we were able to put in-unit washer dryer, we gutted the old laundry rooms and we turned them into fitness centers because you no longer needed communal laundry facilities.
Yeah.
And we also built these really nice, as you see in the photos, we built these really nice modern wooden patio surrounds. So everyone's got a very nice private patio and it looks more modern. And we were able to increase rents by about 50 to 60%.
Wow. Give me an idea what that process looked like, from, I'm assuming based on those existing rents, the place was probably 100% occupied or damn near 100% occupied is my guess based on the location. Is that an accurate statement?
It is.
Okay. So how'd you go about turning through that existing tenant base? Was it a 1-by-1 endeavor, or how's that play out on an 88 unit property?
We start to increase rents a little bit up to market, like unrenovated market. You start to get some attrition. And once you get attrition, we can renovate the units. As we're renovating the units concurrently, usually the first thing we do is renovate the exterior. So we'll start with exterior and common areas and the amenities. And then as units start to turn, we'll improve the units and release them at market rent for a fully renovated unit. Got
it. How do you guys teeter between that fine line of under improving or over improving? I mean, to ensure that you guys are going to get absolute top dollar, but that instead of spending $25K, that you don't end up into it for $35K per unit, and not achieve that higher rent premium for it.
So we've been doing this for a long time now, and we really honed in on that skill. I would be lying to you if I said we haven't had any cost overruns, but we've had plenty of cost overruns throughout our days, but we haven't had any in the past few years, the past 3 or 4 years. We've really dialed that in, and we know our markets. So we will renovate appropriately for whichever submarket we're buying in.
Got it. And then what is the long-term
comps? And sorry, go ahead.
Yeah, no, go ahead. I didn't mean to interrupt you. I think we had a little blip here in the connection, but I was going to ask you. So, what is the long-term strategy? Not with this property, this asset, but everything that you've bought up to today. Is it buy and hold for 10 plus years? Is it a 3 to 5 year strategy? What does that look like overall?
That's a great question. So the answer is both. We've got some properties that will sell, and then we've got some properties that will just refi, hold, and operate. And the way we usually know going into it. So if it's a larger property, which is easier and more efficient to manage in a good high growth area, then we'll want to keep it. If it's a smaller property, inefficient to manage, kind of a pain, in a so-so area, we view that as it's just a paycheck, and it'll help us cover our overhead. And that's not really something we want to hold long term.
Got it. So you guys are in like the 2 states other than New York that rent control probably gets spoken or written about at least one time, if not more, a week in major publications or on major news outlets. And so, talk about your long-term business strategy. And I mean, how do you guys, just generally speaking, how do you deal with the risks that are associated with the current overburdening regulations, future potential legislation coming down the pike revolving around rent control in both California and Oregon? Give me an idea of what that looks like behind the scenes as you kind of navigate those waterways.
So the extreme rent control markets with just very difficult regs, we don't play in those markets. It's too difficult to operate in. We're not in Berkeley. We're not in Santa Monica. We're not in West Hollywood. We're not in San Francisco. Quite frankly, we're not really in LA unless we're building ground up. So that's something I forgot to mention earlier. We do a little bit of ground up development, but only here in our own backyard in LA. And because we don't have to deal with the rent regs, it's much easier to operate in that fashion in LA. But in the East Bay and Portland, there is rent control, but it's pretty loose and we can operate within those parameters. So say, for example, in San Francisco, where you're only allowed to increase rents 70% of CPI. So right now that'd be like, 1.5 to 2%. It's not very meaningful. The Oregon statewide and the California statewide rent control are a little bit more friendly, and it's easier to operate within those parameters. So Oregon is 7% plus CPI, which is around 10%. Yeah, exactly. So over 2 years, that's a 20% bump. And in California, it's 5% plus CPI. So, and then our investors are always asking us, how's the rent control going to work? How do you know you're going to be able to execute on the business plan? And we say, hey, look, at 5% plus CPI, 7.5 to 8% a year, that's over 25% in 3 years. So absolute worst case scenario where no one moves out, which never happens, but let's say you're assuming that worst case scenario, you still get a really nice return because you've increased your top line by 25% without spending any money.
Yep. Absolutely. No, good points there. How about the management side of your business? Your property management in-house, vertical, or do you guys outsource to a third-party firm?
We are vertical. That has been an ethos of ours from day one. We always wanted to have very hands-on, strong management. It helps us control timing. It helps us control costs and just get a better handle of everything in the operations process and in the supply chain. So we do all the property management. We do the project management. If it's in California, we have our own crew. If it's in Portland, Oregon, we've got a couple crews that we work with who work almost exclusively with us. So it's a very hands-on process.
Got it. What are some other relevant facts about Trion Properties? Just again, generally speaking, that we might have missed here today that you'd like the listeners to know about, what it is you guys do?
I think one of the things that's unique to us, or one of the things that we take pride in, is we're investors before we're operators. And we're really looking at it almost like a private equity fund would. Like, what are the attributes of the area? What does this supply pipeline look like? What are the demand drivers? And we try to look at it at a very high level. We look at all these things before entering a submarket. We look at all these things on the neighborhood level. And that is really how you're able to optimize your NOI and optimize your IRRs. So that's why, that's part of the reason why we don't go into markets like Vegas and Phoenix. Not that there's anything wrong with that. People do make plenty of money in those markets, and I'm not knocking it, but they've got very low barriers to entry. So, you can, in Phoenix, you can go buy a swath of land and build 300 units. In Los Angeles, that's very difficult to do because it's fully built out and you've got very difficult land use regulations.
Got it. What have been some of the barriers of you guys getting into Denver? You mentioned Denver as a market that you are potentially looking to expand into, but what have been some of the barriers that have kept you out of there up until this point?
Denver is very, very competitive. So we're not the only geniuses who see that there's a ton of opportunity there. Great barriers of entry, phenomenal jobs, a lot of tech jobs, fantastic migration patterns. So you've got a lot of people moving in there from all over the country, specifically California, New York, because it's gotten so expensive and just unaffordable. Not just with housing, but also with taxes and all cost of living. And it's taken us about a year to really understand the market and the metrics. And now we've got a few deals we're close on. So I have a feeling we're going to make our first acquisition in Denver probably by May or June.
Okay, fantastic. And a very similar strategy, just a very heavy value add proposition.
Very heavy value add. Exactly.
Okay.
We'll probably do some light value add stuff there too. But yes, ideally we'll do heavy value add.
Okay, fantastic. Well, Max, I'd like to enter what we call the lightning round. This is where I'm going to get a little bit more personal with you and ask you 6 short, concise questions, looking for 6 short answers. Very first one, your biggest fear, man, what is it?
My biggest fear, President Bernie Sanders.
Yes, not to get political here, guys, but yeah.
I mean, you never know because
yeah.
And I tell you that not that it's not a matter of pure politics, but he's running on national rent control, and something like that might put us out of business, and might put a lot of other folks out of business, and it would really do. The optics of it, if you're looking at it very surface level, to the everyday renter might seem great, but it's really not. Rent control makes rents go up, not down.
Yep.
So that's really scary to us.
I agree. How about your one biggest regret?
My one biggest regret, I think, is not doing larger deals earlier in our career. Like, now we'll do $30 to $50 million or higher institutional level real estate deals. And we probably could have started doing that earlier. But investing, I'd say, it's a little bit like skiing, where confidence is half the battle. You might have the skill set. You're just, there's certain things you don't want to do because you're scared to do it. Yeah. And it really comes down to confidence. And I think we could have done larger deals earlier in our career.
What's the largest deal you guys have done to date?
$36.5 million purchase with a $41 million capitalization and a $51 million exit for our partner.
Got it. Fantastic. How about the one most influential book?
The one most influential book in terms of real estate, which I absolutely loved, is the autobiography of William Zeckendorf. William Zeckendorf was one of the largest developers in New York history. In fact, I think he might be the largest. Actually, no, at this point he's not, but he's one of the most prolific and largest developers in New York history. He actually built out a lot of Denver, a ton of Manhattan. He built Century City here in LA when he partnered up with Fox. So what a lot of people don't know is Century City used to be the back lot of Fox Studios here in LA. And they had to sell off the real estate because Cleopatra went over budget. And back then the coffers weren't as fat as they are now. So they actually had to sell off real estate to developers to pay for the cost overruns on Cleopatra.
Interesting.
William Zeckendorf teamed up with Alcoa to provide all the steel for the office buildings.
Wow. Interesting. Guys, I'll be sure to put that in show notes. I need to add that to my list as well. I was not familiar with that one. So appreciate that, Max. Sure. How about outside the daily work grind? What do you do to decompress?
Love to go snowboarding. Love to travel. Have my 5 a.m. workouts every morning. And that really helps clears the mind.
Yeah, good deal. How about the one thing that you can't live without?
My family, my wife, my kids, love them.
Good one. If they listened to that and you didn't say that, you'd be in trouble, man.
Exactly.
How about your backup plan? If you woke up one day and just decided that you no longer wanted to, do what you're doing here in the real estate world, what do you think you do with your free time?
I would probably spend all of my free time in the nonprofit space, working, in the education space.
Okay. I love it. Well, Max, this has been a lot of fun, man. I really appreciate it. And, folks, I'll be sure to put that book reference there in the show notes along with Max's website. If you want to learn more about what he's got going on, you can go visit his website at Trion-properties.com. Again, that's Trion, Trion hyphen, and then properties.com. And again, that'll be in the show notes. Max, that's all we have, my friend. Really appreciate you joining us here. Looking forward to following all your future success and give you guys some prayers on my side that you get into Denver and that you make some big things happen there. So very much looking forward.
I appreciate it. Thank you very much for your time and appreciate the invite.
Yeah, thanks, Max. And guys, thank you for tuning into this week's show. And until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.